Lucy, you put on that pair trade apparently on Election Day. Is that a long-term view? Is that a tactical play? How do you see it?
Hi, Matt. Great to be here with you. Thanks for having me. Yes, you're right. As you're discussing, right, there's a lot of policy uncertainty now that's playing out. And I think part of the reason we obviously put that initial trade on to be long US stocks, short European stocks, was exactly predicated on many of the themes you're talking about, i.e. the risk of tariffs, the risk of US exceptionalism continuing, etc. But what I would say is that is no longer our key trade. We've just recently upgraded from an asset allocation perspective, Europe, to say that you actually should barbell it now. And let me tell you a little bit, Matt, as to why we think that's the case. If you think about the policy uncertainty everybody's grappling with now, post-election, you've got four broad buckets. You've got the sort of more negative growth, risk of higher inflation policies around immigration, but, and obviously the impact that a reduced supply of labour markets might have on inflation. People are trying to grapple with that, understand what that looks like. And obviously the tariff piece, is that very broad or is that very narrow? Again, the risk that that's a negative shock to the US. And then offsetting that, you've got the much more pro-growth policies around deregulation or a regulatory reset. And again, within the US market, there's an awful lot of opportunity, I think, still in equity markets when you think about how that's going to pan out, even with the moves we've had, particularly if you look at financials, if you look at climate and energy, if you look at the sort of broad antitrust agenda. So there's opportunities there in the US. And then the sort of fourth bucket, I think when you add all of that up, is going to be fiscal. So although we still like the US, we've actually just upgraded Europe because we think actually right here at these levels, there's an opportunity for that barbell approach.
Right. So, Lucy, it sounds like that was a trade. Let's talk about investments going forward. You mentioned fiscal as well, and I want to talk about the potential pick for US Treasury Secretary. Obviously, all eyes on Wall Street are trained on Mar-a-Lago right now, trying to game out who will actually get the job. You write about Scott Bessent in your notes saying that he should prevent the worst on the rate side. How disruptive could it be if it wasn't a Bessent, if it was maybe one of these other contenders, some of these names that have been floated over the weekend?
Yeah, look, I think to your point, right, you've seen quite big moves in the back end of the curve since the rate cuts in September. I think the back end of the curve's up around 85 basis points. There's that risk of higher inflation, higher rates. I think, as you pointed out, the Bessent scenario, people felt that he would be very careful on the deficit, right? And so he wouldn't allow that perhaps to continue to balloon, despite obviously the concerns around that elevated fiscal spending, i.e. not just the extension of the 2017 tax cuts, but also obviously the potential for corporate tax cuts going down to 15% and a whole range of other things. People thought he would be quite careful offsetting that with other things, including raising revenues from trade and also things like slashing the government spending. And there's clearly an agenda that we've seen with Musk and Trump's comments around being quite radical and disruptive, thinking about that. In fact, one of the baskets that a lot of our clients are really interested in is looking at names in Europe that might be exposed to US spending cuts as we go forward. So I think to your point, if we don't go down the route of having someone who's going to really balance the books, there's going to be a lot of questions asked around that fiscal sustainability and around US government debt and who the next buyers for that are going to be and how much further the back end of that curve could move.
Lucy, what about some of these other nominees put forward by the president-elect? Because you look at Chris Wright for Energy Secretary, RFK Jr. for the Department of Health and Human Services. When you look at some of these nominees, how much do you have conviction or lack thereof in certain sectors? Would you advise clients to put those trades on now?
Well, I think what you have to do is have a broad, diversified portfolio here because that policy uncertainty, the magnitude, the timing, the sequencing is still very unknown until you know who's in the key seats and what those policies are, right? And a good example of that is obviously trade. We don't know yet whether it's going to be very narrow and targeted, for example, just towards China, or whether the trade policies are going to end up being much broader, much more all-encompassing and might target a number of countries. And that can obviously have a series series of fairly negative demand shocks, not just in the US, but for the rest of the world. So when we're talking to clients, that's why in equities, we actually now like this barbell approach of being long both the US and Europe in equities. We like within credit, for example, high yield. We think there's still opportunities in government debt. I think there's a much clearer path to rate cutting that we and others see for the ECB, given some of the structural pressures in Europe. Obviously, there's already an element of pullback that the market's expecting in terms of how much the Fed can cut from here as we go into next year, whilst this uncertainty remains. So I think having a broad, diversified portfolio is really important. But even within the US market, where our bull case for the S&P is 6,100 currently, we're still working through what is that magnitude of growth that you can see from US stocks next year. It's probably high single digit. So that's probably going to mean your upside to US equities next year is going to be high single digit, maybe 10% max. It's not going to be a repeat of this year's performance. Hence that view. It's not just about big cap US tech. Right. You probably want a broadening approach to encompass more stocks in the US that are going to benefit from a series of different policy changes in different places, as we said, whether that's deregulation in certain cases or other things, so that you're exposed to more alpha opportunities across asset classes. And I think that's going to be really important as we head into next year for clients.